Okay, I want to see a show of hands. Okay. Who believes in keep it simple, stupid? Majority. Who feels that if you are able to have a more complex strategy, that could influence your profitability? That's me. Huh? Hey, cannot like that say. Yeah, can be. Okay. Okay, so let's start with SK. Since you are in the keep it simple section. Okay, so why do you think that we should keep it simple? Or why do you think that, okay, let me rephrase the answer. Why do you think that in being more complex doesn't mean that you'll be more profitable?
Okay, let me put it this way. If you have a simple method and you have a more complicated method and both of them give you the same profitability, which one will you go for?
Simple.
See, too simple, right? Don't need to answer.
That's a good one, that's a good one. Okay. So to rephrase, if you backtest two different strategies, one complex and one simple, and the simple one outperforms, then of course you stick with the simple one. Right? Okay, so that's something to take away. Okay? Irene?
Simple.
Why?
Because it can be very conflicting. If you have a lot of indicators and then they don't actually concur with each other to give you a bias. Whereas on a simple strategy, you can just see long shot.
So what if we look away from indicators? Meaning, what time do you trade?
What time do I trade? I trade.
When you wake up.
Huh? What time do you trade?
Mostly European. Mostly London.
Mostly the London session, right? What strategies do you trade?
Currently, it's the full
Trade one, right? Okay. And then, do you look for confirmation or do you place pending orders?
Pending orders.
Pending orders. Yeah, you can see the complexity is increasing already. Right? So as a whole strategy, okay, like what Jerry mentioned, you need to master your strategy. That's a prerequisite to trading profitability. But when mastering your strategy, there will be some element of complexity involved. So Jerry, just now you said you had another answer to this.
Well, keeping it simple just means I'm sorry.
Wow!
Okay, keeping it simple because you see humans like to have a simple way out and a way to think without too much mental labor in coming to profits. I think it's a natural thing in humans to find the easy way out. But I think it doesn't answer whether or not it's profitable. You see? So if it's complex, you know it, and then for each element of the complexity, it will increase your confidence in the trade. Why not?
Okay.
You see, ultimately, you still need to master the strategy. Once you've done that, really, what's the success rate?
True. But and this moves into a very important point mastering the strategy. Okay? You guys need to reach the point, right, where if I tell you that I have a good strategy, okay, and then this strategy has been proven profitable by live testing and back testing, and the strategy works like this, or rule number 1, rule number 2, rule number 3, rule number 4. You guys must memorize all these rules to a T, really, all the way, accurately. So it has to come to a point where Edwin can give me an article and say, hey, I think this strategy is good. And then I read through the article is clear enough, it explains to me the rules, right? And then right away I can backtest it. Backtest shows that it's profitable, I can move it into live marketing, right? And that only comes when you have mastery of the tools that you have, right? If I tell you right now, okay, you know if I take the daily Fibonacci, I take a 61.8 retracement level, I enter long, I target 1.27. And I do that 8 AM every morning, and it's profitable. Right? how many of you can execute the exact same things that I just said, right, to the exact rules? So you see, the key thing is, if everyone, there are a lot of profitable strategies out there. There are a lot more unprofitable ones, right? And for those that they are profitable, you need to be able to master them. So that comes from knowing where's your impulse, which direction, right? What's the pattern you are looking out for? What exactly is the entry, right? The stop loss and your targets. Right? You need to memorize this at the back of your head, and that's one strategy, right? And then for those who feel that, oh, I can't do swing, I want to do scalping, then there's a different set of strategies that you need to have, which can be news trading, right? Entering 5 minutes before the news, placing both sides bracket, buy stop, sell stop, right? Moving to break even as soon as 7 pips is hit, right? Or for those following certain signals, there are certain ways to use them. Once the level is tested, get out. Then 7 pips, cancel, or something like that, right? So, and I know some of you all have been made a bit of mistakes in that part, right? So mastering your strategy is very important, right? And being able to handle that little bit more level of complexity is also very important, because that can actually influence how consistent you are. Okay? So how about this group here? What was your conclusion?
It's the spokesman.
Simple.
To end up in the state where analysis paralysis, contradict yourself.
This is especially true when you see charts that have like 10 indicators on them. I think I sent out one picture with all the lines, right?
Yeah.
Okay.
Abstract art got lost.
Abstract art. A very interesting Picasso picture, right? But you
Very impressive.
okay, if you look at the picture, right, for those of you who have seen it, the slanted lines are meant to confuse you. But if you look at the Fibo, it's actually drawn properly. And if you look closely into the Fibo, you all can open the picture and see. There's actually 2 levels where all the lines are aligned.
I saw the picture straight.
Yeah.
Next.
So what that person did, okay, a bit of, it's probably, I suspect, the original analysis was that. And then he or she add a lot of random stuff to make it a Picasso, and then show it you all as an art piece. Correct? But to be able to see through that, this person might be trading confluence of Fibonacci zones, banking on different highs and lows. Right? So to be able to see through someone else's strategy, keep laughing. Yeah, so the Picasso art reader. Yeah, so it's basically a mess of charts and lines, right? But you see whether you can find the 2 thick horizontal lines on the chart. That's the confluence of the level. Yeah. Okay. Of course, a bit of smoke screen lah. She added a few other levels. He or she added a few other levels. But you can see this person might be trading confluence. Okay. And if you look at the tools, the person uses a lot of fit fan, fit time, fit retracement. Right? So probably a very Fibo pattern trader. So even though it's a Picasso, it's an art piece, you can still find out what kind of trader they are based on the fact there's almost no indicators. Or is other indicators inside? Very few indicators. Or is it they added some random indicators? Yes. No indicators. So right off the bat, you can see these traders bias. What kind of style they are. Right? Not that it's any helpful, right? Okay. So Vincent thinks keep it simple, right? Because of analysis paralysis, right? And of course, I think some of y'all who are very familiar with indicators, y'all will know the few major types, right? Your oscillators, right? Your trend indicators, right? Usually these 2. And then what happens is you will see some people combine 2 oscillators or even 3 oscillators together, right? Which sometimes, and even with the same period, and that can actually make it more confusing because oscillator is meant to find overbought and oversold levels. You usually only need 1, and then you compare it with a trend following indicator like a moving average, for example, or a MACD, right? So you need to combine your indicators in a way you don't find analysis paralysis. For example, a long-term oscillator, MACD histogram, or another long-term oscillator like your analyse CG, the CG indicator, and a short-term one. And if both give you a buy signal, it tells you that short-term you're looking for buy, long-term you're looking for buy. Right? So that handles the complexity, right? And that also reduces analysis paralysis because you know what your indicator is trying to tell you, which boils down to mastering your strategy, right? Okay, all strategies start out as simple, right? Be it a trend line, for example. Let's take a trend line, and then after that, you need to think of how am I going to draw my trend line in the way that best fits the chart, right? And then do I avoid news? How should I trade it? When should I trade it? So usually the complexity part starts when you question yourself based on your simple strategy, when should I actually enter? Right? Okay, how about the group at the back? Any discussions or any points of interest that you all found? Simple or complex? Anyone? Simple. Okay, why simple? This one is very important. Okay, each pair behaves very differently. Okay, so you see from here, we gather a few things. Okay, most of you all agree it's simple, but there are certain things you need to add on to it so that you master the strategy. Right? The other thing is also the strategy will fit certain currency pairs in the best way. Right? So for example, Kayong mentioned dollar CAD pair of the year, right? And then you want to go short, right? Which means, firstly, you don't want to be long. Second, you want to enter on corrections in the short side, right? And third, if there's a chance to scale in, you want to scale in. Versus another currency pair that might not be the pair of the year, right? A ranging pair, you want to probably enter into based on more on the general impulse direction, right? And maybe more on the, you wouldn't want to scale in, for example, right? So you can see the strategy itself is simple, impulse correction, right? But the way to engage it, that's where it starts to get a little bit more complex, and even more complex when you look at different currency pairs because they behave differently, right? So that boils down to mastering your strategy, knowing how to use this simple thing in different situations, right? So for me, okay, I believe that the strategy's level of complexity, okay, can influence your profitability, but doesn't mean it's going to make it more profitable. Because if you don't know how to handle it, you don't know how to handle that complexity, and you have not tested that, right? You will not be able to be consistent because you don't understand your strategy. Okay, so a typical process for coming up with a strategy is you start simple. Okay, if I have an impulse correction and I trade the correction, can I make money? A. Right? And then how can I trade the correction to enter so that I can catch the impulse? That's the next question, right? And then you build on, you add in a bit of complexity, right? Patterns. Right? So ABC, I want to catch the end of the correction to trade the impulse up. So I have my buyers ready. Then after that, my question, the scenario goes on to what happens if it doesn't play out and the correction continues, right? So I need something to trade that market condition, right? And what if my long-term buyers tells me that, hey, this pair can go very far, dollar CAD. That's it. Right? Then how should I maximize this potential? Right? So through your scaling in methods, which you all were taught. Correct? So can you see how as I start with something simple, I layer it, right, in such a way that it becomes slightly more complex. Or to put it as what Jerry said, right, slightly harder to master. Right? Because even though it's simple, but to master the small little things, right, and for a particular pair, that's the difficult part. Which means you guys need to journal consistently for this pair. Alright, how is it behaving? How am I going to engage this pair with my trading strategies? Right? Alright, so I'm going to share a little bit of an example of a strategy formulation process, and then how it gets a little bit more complicated. And then you can see how there's actually many things to think about. Alright, so let's talk about moving average again. We'll just make it very simple. Okay, so basic FX, for those of you inside, they do teach a bit of moving average. Let's go with the 50 cross 200. Who here is not familiar with crosses? I think all here should have heard of 50 cross 200. Right. Very simple strategy used by a lot of commodity trading advisors, trend followers. Right. 50 cross 200 long, cross back short. Right. Then the next question is which time frame? Daily, 4 hours, 15 minutes, 5 minutes. That's one. Third, how wide of a stop loss do I want to put? Right? So, have you mentioned 280 plus an ATR? 1 ATR? 1.5? 3? Right? Okay. Fourth, do I want a hard target or do I want to exit manually based on the opposite cross? What happens if I exit purely on the cross? What can happen is, number one, my profit potential is unlimited because it can fly. Number two, my loss is also unlimited because it can drop. So do I want to limit my risk by putting a stop loss? A hard stop loss. And how far should that hard stop loss be? So you see, I'm layering on, it's just a simple MA cross. Then after that, I find that when I MA cross, I find that 50 and 200 maybe cross a bit too early, and then I get whipsawed out. So maybe I should enter when 50 and 200, 50 is above 200 by a certain amount, so that I'm capturing, for I know for sure that the trend is going to continue. Okay, so I give you all some things to think about. Okay. Then after that, I find that Friday I have gaps. Right? Weekends there's gaps in the trading. Okay? And when it gaps, it goes against my stop loss. It goes beyond my stop loss, and I end up with a loss much higher than I intended. So should I trade on Fridays or not? Okay, getting more and more complex. Then we go on to risk management. With no stop loss, can you determine how much risk to put? So far, you all are taught percentage method. That comes with a stop loss because you need to calculate how far the stop loss is. No stop loss, how much to risk? Right? Okay, so something to think about. If no stop loss, how much to risk? Or if I want to put a stop loss, how far should it be from the MA, for example? Okay. Then after that, I find that I backtest and I find that wherever one trade wins, the next trade tends to win. When one trade loses, the other trade tends to lose. And I find that there's more losers in a row than winners, and it's not profitable. How can I modify that such that my P&L will look something like 1 win, 1 lose, 1 win, 1 lose, but the win is always more than the loss? So I can start by maybe number one, I go with a RR or risk reward of more than 1, 2 ideally, right? So that I can make back what I lose, right? But then there's the problem of clustering. Right, you have losses coming in 5 times in a row, and then you have profits coming in 2 times in a row. So minus 5 plus 4, 2 times 2, 4. You still net loss 1 in the long run. How can I space this out? Well, maybe I can say after every trade, wait for the next week. Do not trade right after that. Right? Okay. Then after that, I find that when the news period is very high, it tends to hit my MA loss very fast. It tends to hit my stop loss or the opposing MA very fast. Especially if the entry is right before a major news like FOMC. So what can I do? Before FOMC, I can move to break even. I can choose not to trade, right? Or I can take profit if it's already in profit. If it's in stop loss, I might want to tighten the stops, right? Or I want to leave it there. Right? Never widen your stops, because with widen your stops, you're opening yourself to more risk, right? Okay, so again, another variable introduced. Right, so very simple technique, like an MA cross, right, can be used in many different ways, right, at varying levels of complexity. Okay, if you try a 50 cross 200 across all your asset classes, across all your 24 currency pairs, and you just trade blindly, cross trade, you go and look at your P&L after that, it won't look good. If you try a Bollinger Band, okay, I can share this because I've done it. This is...
So the 3 currencies on my watch list this week is Aussie, Pound and Dollar. Okay, but US Dollar is definitely the focus for this particular week. Okay, so because of that, I'll just show you the dollar index first. So this one here on daily, what is your bias? Yeah, okay, so very clear cut right now. Yeah, okay. So take the complexity away, a very simple one. So this is down, not up, right? Okay. See, so now who is the one being complex? Okay, Okay, later I'll show you the complexity, but let's keep things simple first. So this one, bias, all of you would agree is down. Okay, there's no sign of it going up as of now. Okay, so this is daily. Daily, even the last move, if you focus here, is pretty strong. Okay, then now we decide to go 4 hour. Okay, basically 4 hour here is also down. Okay, I have this very interesting Edwin who asked Lester, is it? If you see a small crawl down, does it count? Okay, so Edwin has a very good question over dinner just now. He actually asked Lester this. If you see a strong impulse move, which is this one strong candle here, followed by some slow down move like this, is it considered what I call a crawling move down? Yeah, so a recap, you all know that there's 3 types of move in the market. Okay, one is V shape, right? Okay, then the second type is a crawl up, or I'll draw the crawl down first. Like this, this is your second type. Then the third type is like this. Okay, so Evan asked, does this here fall under this third category? Okay, the answer to that, okay, is if this move is so small, give it more time to prove it to you that it's forming. Okay, because here is really, and it's end of the week, it's Friday. Okay, so this here might not be indicative at all. Okay, so what you're going to do is give it more time to show you that if it's really doing the third scenario, which is crawling down, then you give it more time to crawl down more first. Okay, but as of now, this one here is showing you that it's still downside. Okay, okay, then if you really want to go 1 hour, okay, this is where your 1 hour might start to show you that this is an impulse, and then it maybe start to show crawling down. Most of the time when you see crawl down, you would have a divergence happening. Okay, so basically, if you look at dollar index, take away all the counting, all the labeling, right? So based on just these 3 here and based on the concept of impulse and correction, right? 1 hour, you wouldn't want to sell now because it's showing you this as a high chance that it's gonna reverse. Okay, if you look at 4 hour, what's your action? Wait also, because it either continue to do this, or it can do a sharp reversal, or it can do a slow up move. Okay, so again, this week dollar here until before FOMC, there's nothing much you can do lah. So same for daily. This is just strong impulse move. Okay, so right now, if you just based on simple term, that means you just never put in your fib, never put in your counting of wave. Your analysis here on dollar index for this week is to see what is going to develop. H1 tells you that high chance you will see a reverse. Okay, H4 and daily, not enough information yet. Okay, so this is what you can get. But if I now plug in the analysis, okay, so for those who have a little bit of knowledge and wants to put in that counting, that's where you all say, very complex and things like this. Okay, I'll start on weekly because weekly give us a better picture. Okay, so this one, if you are looking at weekly, this is your impulse. This whole part here is correction. Okay, so based on count, okay, this one here is a bit complex, but I'll just count and show you, follow me how I do the count. Basically, this is the most recent bottom back in 2008 for the dollar. Okay, then it came up and then it comes down. This whole part here is correction. Okay, so this is my first up, my second down. Alright, then this whole part here is where my third one up. Okay, so this whole portion is actually a third wave. Okay, within this move, you also have 1, 2, 3, 4, 5. Okay, so what is happening right now here is potentially my fourth. So this is 1, 2, 3, this is fourth. Okay, so fourth here, it has reached this zone that is what we call the minimum expectation for wave 4. Okay, meaning most of the time, very common Fibonacci area for wave 4 is 236 and 382. Right now, price has entered into this zone. So from my perspective is, if price has entered into the minimum expectation for wave 4, meaning most likely or high chance that wave 4 has complete. So once wave 4 is complete means I'm no longer interested to short. Okay, because if I short it, the downside might be limited. Yeah, so that is my weekly bias. If I now go to daily, okay, so daily, just now you all see this, this is where the down impulse move happens, right? So if you look at this, now you have 1, 2, this whole thing here is 3. Okay, so within this 3 you have 1, 2, 3, 4, 5 now. Okay, so right now again, this 3 has met the minimum expectation. So again, because of that, if it meets the minimum expectation of this move down, I'm expecting a retracement up. So again, this time frame tells me it's not a good opportunity to short because the reward, the downside potential might not be there. Right? So again, daily, the expectation here is already met, the minimum expectation has met, so I would not be interested to look to sell. Does it mean that it's definitely go up? No. Does it mean that it's not going to go lower? It's also no. It's just that as a trader, my reward or my edge of shorting it is no longer there. Okay, therefore I don't look to short. Alright, but just now I shared, so daily and 4 hour, you do not have sign to buy yet. Okay, so again, I just want to share with you, all this arrow doesn't mean you straight away go in and buy. Okay, so this one, H4 is where I want to show you that internal 5 count over here. 1, 2, 3, 4, 5. Okay, so again, this one here has met the minimum expectation and therefore it's not interested. I'm not interested to sell it. Okay, so all this, when I put all this, that means just now based on without all this labeling, without all this Fibonacci, okay, the conclusion is same. We are not going to sell. Okay, and if I put all this in, it gives me additional info to know that all this move has hit the minimum expectation. Okay, what it means to me is instead of looking for opportunity to sell, if I'm a counter trend and I'm an aggressive trader, this week I'm going to look for this reversal. Okay, what can be the catalyst to give us that reversal? It can be your Fed on Thursday that gives you that reversal. The catalyst to push your dollar stronger. Okay, so this week my bias on dollar is I'll be looking for reversal to the upside. That means I'll be looking for buy, but it's gonna be an aggressive trade. It's gonna be a counter trend trade.